Waminjika. I'd like to start by acknowledging the traditional custodians of where we're meeting this evening and pay our respects to the Wurundjeri people and to all people of the Kulin Nation. I'd like to thank Uncle Ian Hunter for his welcome this morning, and I'd like to thank their elders, all elders, past and present, for looking after these lands and these waterways for many, many generations. And welcome all, welcome to the 2024 Australian Banking Association, the 70th anniversary gala dinner. It's great to have you all here. And so I keep looking at Anna because I know twice today we had the conversation about this dress. It's almost a maroon dress. And after what Adam just said, I've got to say, I've got the blue shirt on, so at a great risk of annoying a whole lot of people, come on the blues tonight. We shall see, we shall see. So my name is Andrew Groth. I look after the Asia-Pac business for Infosys. I'm also on the Global Financial Services Executive, and it's my absolute pleasure to welcome you to this dinner after some great, candid conversations today. It's been really, really tremendous discussions about strength, about resilience, and about readiness for the future. We talked about some very proud moments in the 70 years of history. We talked about some proud moments of what's going on in the Banking Association right now. I thought there were some very interesting observations. There were some very sobering facts that we looked at as well. But I think overall, there is very positive opportunity for the future. Many of you will know Infosys is a leading global leader in next generation digital services and consulting services. And for decades, we've worked with leading banks around the globe. And what we're seeing is 2024 potentially really could be a watershed year in terms of where we are as an industry and the potential that was there. There can be a very positive future for the banking sector. The ability to process data, the volumes of data, the speed of processing, the impact for digital transformation at speed that has never been possible before. The expanding AI adoption that we're seeing more and more at an enterprise level, the ability to transform experiences for customers, for our employees who are servicing customers, it's fantastic. And we actually track this on a quarterly basis. We have a quarterly banking index that looks at banks across the globe and how they're preparing for this future. If you want to get a copy of that, you can get it from the Infosys table outside, or you can download it digitally later after the event. But, the question we look at is how do we navigate for the future in this environment? I've actually just returned from a 2-week trip. I've had customer meetings in Singapore, in Mumbai, and I spent some time in the US at an Infosys Global Conference. And through that couple of weeks, I saw many, many examples of the work that we're doing with customers around the globe. And what stands out to me is the success for this future. It's really about partnership and collaboration. And those relationships where we have the strongest partnering together, they're the ones that make the most success. Adam this morning talked about this being a family and collaboration and working together. It's where we have those partnerships where things can make a difference. In the US, for example, I saw work that we'd done with organisations like Amex and Citizens Bank, where through that collaboration, we'd really made a tremendous impact on consolidation with significant savings in costs, in operating ratios, digital transformation for customers and employees. Further afield, one of the great examples I saw was in Denmark with Danske Bank. And Danske Bank have really taken the whole AI discussion that we were having today to an enterprise level. And it was talked about on the panel about learning, using AI as a tool for learning and really embedding deep collaboration that focused on making a difference, a measurable distance, again, something that Telstra spoke about on the panel today, making a measurable difference at that impact level. So great partnerships drive meaningful change and can drive that positive future. And those partnerships can be across all sectors. As Shane Elliott said this morning, it's not just about learning what's going on in the financial services sector, it's learning from other parts of the economy. Right here, just up the road, next to where the rugby's been playing, is the Australian Open. We've been the digital innovation partner for the Australian Open for many years, and we've been using artificial intelligence, digital transformation, augmented reality, and it's made tremendous difference for the players, the coaches, the media, and the fans, the way that fans can now engage with the game of tennis, a game that's been going for over 100 years, engage with that tennis in a different way, whether you're physically at Rod Laver Arena or whether you're participating virtually around the world. It's made a big difference. Banks, of course, are the oldest institutions in our society, enabling commerce, supporting communities, and now at this future inflection point. So the evening we have come together as a family, not just as individual institutions, but as a community that shapes economies, that empowers dreams, that has shared purpose that transcends all our individual balance sheets, and it's up to us to make that positive future that I think is potentially there. So how do we nurture that positive future? How do we navigate our way through that? On that note, it gives me great pleasure this evening to introduce our keynote speaker, Brett King. Brett is an international best-selling author, a world-renowned futurist and media personality. President Xi Jinping cited Brett's book, Augmented. Brett also used to advise the Obama administration on Fintech. He's the host of Breaking Banks, the world's #1 Fintech radio show and podcast. He's also the founder of Moven, a globally recognised mobile startup, which has raised over $40 million and launched the first in-app mobile bank account offered across the globe. Banking Exchange named Brett King, the king of disruptors. He was nominated as American Banker's Innovator of the Year, voted the world's #1 financial services influencer by the Financial Brand, and listed by the Bank Innovation as one of the top 10 coolest brands in banking. One of the most influential Australians offshore. So in his exclusive keynote tonight, Towards Banking 5.0, Resilience in a Time of Rapid Transformation, Brett's going to introduce us to some new research and what it means for the future in terms of market share, policy settings, and consumer rights. And yes, he will also dive into technology over the next decade and maybe challenge some of the concepts of what we think a bank is really about. So with that, to help us navigate the future, please all join me in welcoming Brett King. Thank you, Brett.
Thanks, brother. Appreciate it. Thank you. It's nice to be back in Melbourne. I'm a Melbourne High boy, so it's sort of like, coming home, and to be able to speak to you guys is a real privilege for me, and I feel like, it's wonderful to be back and basically take all the learnings I've had offshore over the last 25 years or so and give you some of that. But I'm going to get futuristic tonight, so. There's this running joke we have is, you know what the definition of a futurist is? It means never being wrong today. But when we look at futurism, and it's not peering into sort of the looking glass and the crystal ball and trying to predict the future. Futurism is about forecasting. We call it super forecasting. So when I talk about the trends today, I'm going to be telling you what's happening in the world today of banking, payments, and so forth, but where the trends are taking us and what that means for the business today. Because the reality is, when we talk about the impact of artificial intelligence alone, and that's before we even talk about, late-stage capitalism, artificial intelligence, climate change, inequality, and so forth, all of those elements. Just AI alone is completely going to transform what we think of banking. And it's going to happen probably much quicker than we expect it will. So I'm going to try and help you to think like a futurist a bit tonight. But let's start off with sort of some macro view of some trends so you can sort of get a place of where this stuff fits in. Over the next 20 to 30 years, as we inject artificial intelligence into the world's economies, we're going to see, just like we did with the Industrial Revolution, a differentiation of traditional economic values versus next stage economics. And that is really going to be around smart economies. So highly autonomous economies will be those that are most successful, using automation, using artificial intelligence to produce incredible capital growth and so forth. Now, this has some challenges with it because it sort of restructures the way we think about society, the way we think about economics. And for this reason, the more and more research you do into the future of economics, the further away we get from classic capitalism. I'm not saying socialism or communism, because that's not, it's not binary like that. But it will say that the more we automate society, the less we rely on human capital, and there we go, digital. What do you say? The more we sort of change the dynamic of operating systems. So then, who are going to be the smartest economies in the world? Well, it may not be obvious, you know. The United States may not be one of the world's smart economies in the 2050s, because if you look at the way the political system in the United States works with the lobby groups and so forth, then you see a lot of effort being made to keep incumbents in their position of influence and power when it comes to policy setting. But if you look out at the late 2030s, early 2040s, we see China being the world's #1 economy. We're going to talk about that in a moment. And India being the world's #2 economy, and the US slipping, you know, in the 2050s to #3. And then economies like Nigeria coming up in the future because of growth opportunities there. But even the way we think about growth in the future may change. Now, AI is a big part of that. Everyone's talking about AI right now. And when we look at AI, keep in mind over the last 60 years or so, since the days of Dr. Rosenblatt with the concept of perceptrons, which is the very early neural network frameworks back in 1956, I think, through to Geoffrey Hinton with deep learning and Yilan Kun and so forth, you know, we have always had the intention of robots and artificial intelligence or automation being labor-saving devices. Remember Rosie the robot on the Jetsons? You know, she used to do the homework with the kids, she'd cook the meals, all these sort of things. For 60 years, we've been imagining what a world of artificial intelligence and robotics would be like, and we've had the clear intention to make our life easier by eliminating, you know, humans from the workforce using automation. That has always been the intention of AI. So when you hear people arguing that AI, yes, it may impact some jobs, but you know, whenever we've had a new technology like the internet come along, or the telegraph line, or whatever, or computers, we've always created more jobs to replace those lost by technology. We've never had a technology that can attack every industry and every job, white-collar and blue-collar jobs at the same time, simultaneously over the space of a decade or two, replacing those. So it's not really a good equivalence to talk about, say, the internet with AI. And if we go back to Friedman economics in the 1970s, the ultimate productivity tool is eliminating humans. How do you make Uber the most profitable autonomous driving taxi company in the world? Eliminate human drivers, have autonomous taxis, right? And you can hear Silicon Valley talking about this already. Sam Altman talking about a 5-person unicorn or a 5-person decacorn. Do you know what a decacorn is? It's a $10 billion company, right? Unicorn's one, right? So Sam Altman's talking about this is what AI is going to allow us to do, build a 5-person AI-led billion-dollar unicorn company. So Silicon Valley is very clear about this. The intent of AI is to create the most efficient form of corporations on the planet using technology that are humanless corporations. And so the impact of technology unemployment should be clear. But when we look at how this gets done and built at a grassroots level, you know, in terms of automating economies, the building blocks of the economies are things like this, smart contracts. Now, you may have heard this term in the DeFi space, but we can borrow from the DeFi space in this, but really what we're talking about is autonomous corporations running legal contracts and financial contracts between various autonomous entities, strategic business units, working together to create autonomous trade. And this is going to be cross-border. You know, we can see some of the areas in smart contracts where we're working this already. But this is probably the single biggest opportunity banks will have in the next 30 years or 50 years, is running autonomous banking operations on smart contracts, or whatever we call those autonomous operations in the future. But here's the rub. You can't run smart contracts on a core banking system, and you can't run smart contracts using fiat currency. So we have to use digital programmable money, and we have to use extended technology stacks to be able to do this. Your current systems won't run this. And this is a challenge because with such a massive opportunity, running the world's autonomous businesses and banking systems in these AI-level operations in the future, all of the skills you learnt in banking in the 20th century have zero reference for this future world. They don't give you any strategic competitive ability in this world. So it's a new set of skills that are required to stay competitive in this autonomous world. So we think about what this autonomous world might look like. This is a movie from Netflix called Mute in 2016. And you can see in this environment, you see this drone running off with a food pack, right, from this automated chef station. So he just ordered this meal. The protagonist, in this case, he wakes up in his apartment. The drone has just dropped off his meal and lets itself out the window. He gets up from having his rest on the couch or whatever, and there is the meal delivered by the drone. Now, this looks like science fiction, but eBay, Amazon, Alibaba, Walmart are all working on this type of drone delivery tech. We have Mercedes working on these vans that will pull up to a neighborhood and distribute delivery robots that will, be wheeled robots and drones that will drop packages at your door and so forth. There's trillions of dollars being put into this sort of automated supply chain capability. And the effect of this is fairly obvious. Now we won't have, DoorDash and Grab and, these sorts of guys delivering meals anymore. You won't have taxi drivers driving taxis anymore. This is going to be automated. This is going to be one of the elements of automation of society that we're investing in because of the massive wealth that it's going to create from a stock market perspective. So in this environment, around the late 2030s, China becomes the world's largest economy. And this is for a couple of reasons. One is if you look at GDP growth per capita, this is when they exceed the United States in terms of their economic growth. But China has been investing in next level infrastructure for an autonomous economy for at least the last decade. They put $11 trillion into the Belt and Road Initiative. They are thinking about this every day in terms of how they build this next generation economy. And if you're looking at this and you're skeptical about this, just understand another element of this. About 2038 is when the US hits their debt cliff, where US national debt reaches 200% of US GDP, where it's no longer sustainable. And at that point, what level of confidence will the global markets have in US Treasury bills and the US dollar in that environment where US can no longer service their debt? This gives China a strategic opportunity. But more than that, China is building policy and cross-border relationships to become the world's largest economic trading platform. So we see this in terms of their approach with cross-border arrangements and so forth. And the main use for CBDCs is not going to be retail. In fact, the emphasis on CBDCs is probably less going to be on retail around the world. We may use tokenization, stable coins, crypto, and other things in the retail environment. But the real power of CBDCs will be cross-border trade in terms of creating standards of money operation in an autonomous fashion that work cross-border. And in that basis, China has this massive advantage with the Belt and Road, which is already AI ready. And their economic colonization of the world will be based upon this type of investment in 21st century infrastructure, autonomous ports, autonomous shipping, and so forth for supply chain automation. Now, obviously, China's doing this for their own benefit, but this is also their economic strategy. So when you look at the BRIC alliance that's emerging and you see Brazil, Russia, China talking about the fact that they're going to move away from the US dollar currency, yes, this is going to take 10 or 15, maybe 20 years to come to fruition, but there's a very clear plan. And geopolitically, you can start to see other nations now recognizing that this is going to be China's century or the Asia century, at least up until the 2050s. And this is where the core economic growth is going to come from, the smart economies. And the US, even though they have Silicon Valley, when you look at their approach to fossil fuels and things like that, you can see that the effect that policy and lobbying groups in the United States have had on slowing down core innovation in these areas in the United States, which gives China this competitive advantage. Now, for Australia, this is both good and bad news. It's good news because China's a major trading partner with Australia. It's bad news because policy has turned against China over the last few years, and we're going to have to get over ourselves in respect to our relationship with China, understanding that, you know, we have to work with China. We really have no choice. The US has figured that out, and other countries will as well. But when we focus on the banking sector in this environment of change, we get this very clear trajectory that's emerging. Now, I talk about these different eras of banking, Bank 1.0, 2.0, 3.0, up to 5.0. And 1.0 is classic traditional banking, you know, branch-based community banking that emerged from the Medici Bank and likes of that in the 14th century in Italy. And then in the 1980s, you have self-service banking emerging. We have ATMs, call centers, and then internet banking. But that was really, when we talk about multi-channel banking, it has to be clear that when we talk about multi-channel banking in this sense, we're actually talking about multi-channel branch banking. Because we didn't change our processes or policy, we reinforced the product structures and the process approach to support the existing branch business. Branch was still the core of our business, and multi-channel was there to support that. So it was branch first, digital second. But things started to change in 2007 with the emergence of the smartphone. Thanks to Steve Jobs and Johnny Ive producing these supercomputers that we carry around in our pocket. I'm sure you guys have heard similar comparisons to this, but you know, to produce a computer of this ilk in 1990 would have cost you $48 million to produce a computer like this with this compute power. You have roughly 11 million times the processing power in a modern iPhone that Neil Armstrong and Buzz Aldrin had with their navigation computer on the Apollo spacecraft. So, you know, incredible advances. But in 2007, with the mobile app ecosystem that came along, we had the emergence of the first type of different banking and payments architectures. Banks and banking systems that could now be optimized for real-time operation on a handset. And it was the first time we really diverged since the 1400s in terms of design of a bank, because banking was always community-based, was always based on those types of in-community structures. Mobile gave us the ability to diverge from that. So now we see buy now, pay later, and these contextual savings and contextual credit elements coming. This is the Bank 4.0 embedded finance world. And we're going to take you on a journey to 2050 today to talk about autonomous or AI-based banking over the next few years and how that emerges. But that's the timeline we're on. Nothing's going to change that. There is never going to be a time in banking where branches are as important as digital ever again. Right? That's never going to happen. So, and I guess most of you guys are happy with that. I get labelled as sort of the anti-branch guy, but I'm just reading the numbers, right? Reading the tea leaves, as they say. In 2025, this is the ecosystem that's emerging today. So we have the surviving banks. We have the tech giants, players like Apple and Google getting into these ecosystems. We have fintechs, some of the largest FIs in the world, which we're going to talk about. And of course, we have AI and data players coming into the mix now, creating these real-time banking experiences through the technology layer. Today, for every one interaction a customer has with CBA or ANZ or Westpac or NAB in a branch or on a call center with a human, they're going to have 350 to 500 digital interactions. So it's not even close. Digital is the dominant way. And when we throw AI into that mix, it just pushes the needle towards AI more in the future. So the biggest banks in the world recognize this change. JP Morgan Chase's strategy just since 2021 has been acquire 40 fintechs of their own. They have strategic relationships with over 1,600 fintechs today. And they recognize one of the things that's sort of at the core of the difference between fintechs and incumbents is fintechs bend space and time. They can always build the tech faster and cheaper than an incumbent will be able to build. And so that's one of the ways to accelerate your innovation is by acqui-hire or acquiring IP from these new players. And when we compare banking to technology players, who has more developers? Who has more technologists? You know, Facebook, Twitter, Chase. Who do you think? Well, it's not even close. Chase has more than Facebook and Twitter or X combined these days in terms of core technologists. So you better believe that banking is a technology industry moving forward. That's it, you know. And the fastest growing banks in the world are all digital players, and we're going to illustrate that in a moment. In fact, I would argue that the market share is already shifting. Now, we don't see it in asset size, but when we, you know, often when I go in the US, when I go to banking conferences like this, you know, banks will introduce themselves and they'll say, you probably had this yourself in the States, oh, I'm with Citizens of Edmond, or I'm with Navy Federal Credit Union. We're a 30 billion asset bank. You know, that's how we communicate traditionally about the size or capability of our bank. But when you look at the Bank 5.0 world and the autonomous economy, your asset size has almost no correlation to your ability to succeed in the future. Your tech stack is far more critical. Your culture is far more critical than asset size. And that's something that we have to adjust ourselves to in terms of this. Let me illustrate. The largest financial institution in the world by customers is in China, Ant Group. You know, the parent company of Alipay, Lufax, you know, Yuibao, a bunch of other players. You guys heard of Yuibao? Yuibao was a small savings feature that Alipay introduced into their mobile wallet back in 2016. By 2018, they had $300 billion of deposits in an asset pool in Alipay's mobile wallet. Now, as a traditional banker, you could try to explain that. Why was that? Was it their high yield interest rate? Yada, yada. It basically came down to one thing. They made it very, very simple for people to save money, just one click. Yuibao's name is hidden treasure. And they would say, you've got this hidden treasure in your wallet. It's money sitting there that could be earning interest. Click now to earn interest. So that's not a savings account, that's a savings experience. Ant Group is also the largest insurer online in the United States and the largest lender for SMEs, and we're going to talk about that in a moment. But this has all happened since 2014. In 10 years, 1.6 billion customers that they've grown. Let's look at some other examples. WeBank, about 430 million customers today over 9 years. 250 million of those customers, 250 million customers, it's their first bank account ever. Right? That's pretty impressive. So when it comes to financial inclusion, these new wallet ecosystems and these new fintech players have been doing very well. The average loan size for those 250 million customers is about $50 US, right? About 351. But let's put that in perspective. A $430 million customer bank in the space of 9 years, fifth largest bank in China, communications bank, 190 million customers. If I gave you about $20 billion, which is what WeBank invested before they listed, and I said, go and build me a bank with 400 million customers using only branches, could you do it? I don't think you could. I don't think that's possible. And so one of the things we're learning is the most effective form of deposit acquisition and customer acquisition is digital. And that's likely not going to change in the future. Nubank, the largest bank outside of Asia today, larger than all of the big Western incumbent banks in terms of customer numbers. 8 years old, they IPO'd in December 2021. Today they have the largest market cap of any bank in Latin America. $5 blended acquisition cost, 30% lower credit card delinquency than Itaú, Santander, BBVA, and so forth. Pretty impressive. The primary bank for 50% of their customers. And today, the largest bank by market cap in Latin America. Itaú, a 100-year-old bank with now 57 million customers, I should update this, If you listen, if you're an executive, if you're in the exco of one of the banks here, I encourage you to go and listen to the last couple of quarterly earning calls from Itaú. What do you hear on those quarterly earning calls? This is our response to this product from Nubank. This is our response to this market entry from Nubank. They don't even talk about Santander or BBVA or Bradesco anymore. They're only focused on Nubank as a competitor. Now in Australia, we got lucky because there seems to be a critical mass required for new banks or neobanks, rather, challenger banks, to get to critical mass, which is somewhere between 30 and 40 million. Customers. So unless you can create a neobank in Australia and get it offshore, you're probably not going to get to the requisite size to be able to have that growth. But let's compare a few others. Revolut now has got 43 million customers, again, over the space of 9 years. Sorry to do this to my friends at HSBC, but 39 million over 159 years. But if you look at the big four banks in the UK, they've lost about 25% of their market share when we look at direct deposit of salaries since 2014 to these new challengers, Monzo, Starling, Revolut, and so forth. And the reality is, if I take you out 10 years in the future and say, who's going to be the biggest bank in Latin America, we already know the answer to that. It's not going to be Itaú, right? And so, if we look at who's going to be the biggest bank in Europe over the next decade, we also probably know the answer to that. It's probably going to be Revolut. And you could argue, yeah, well, they don't have a credit business yet. They don't have the assets of us. But which type of organisation is going to be best placed to integrate AI and take advantages of those technologies? Because that comes back to the agility of the tech stack. The number 3 bank in the German market, N26. Chime now has more primary customers. These are customers that say their primary bank is Chime rather over Chase, so more primary customers than Chase. And this is the trend we're seeing all around the world. Australia's been pretty lucky with this because of the market size and so forth, but it doesn't mean we're immune to these changes, just like the US has tried to resist the growth of these fintech operators. It's been fairly aggressively placed against banking as a service and fintechs in that market. It still really doesn't matter in the scheme of things because technology will do what technology does. So as a result, when we look at the US market in terms of branch decline, it's pretty clear. We think that probably around 2030, we'll get to about half of the branches that they had at their peak in 2008. And we don't see anything on the horizon to slow this decline down. When we look globally, we hit peak branch in about 2015. And again, this is not something you hear central banks talk about, but this data is compiled with World Bank data and central bank data for the G20 and Eurozone. And the only economy in the G20 today where branch use is still increasing is India. And you could argue that's because of a branch density deficit that they have there. But even then, we see it slowing down. In Australia, we changed the way we measure branches a few years ago. So we have now points of presence versus bank branch numbers, but the trend is fairly clear there. Now this presents an issue because we know that the importance of branches declining economically in the sort of the operation of banking over time, but there's social pressure on us in terms of what happens with the branches. The clear economics are, this is data from the Reserve Bank of India from a couple of years ago, showing that if you invest $1 million in a branch versus $1 million in digital, the digital benefit is 300 times deposit acquisition for what you'd get in a branch, right? So, some pretty interesting statistics there. So what this means, if you have branches left in your network, moving through this process, your branch just has one job now, right? Your branch is there to support the digital business. That's it, because the reality is, if you're not a digital bank moving forward, you can't compete with the fastest growing banks in the world. So branches have to have the mission of supporting the digital. Now they can do that. We can have meeters and greeters in the branch. We can have people showing them how to put the tech on their phone and do all of those sorts of things. We can help with that transition. But again, players like Revolut, Nubank and so forth, they don't have to decide between whether they invest in the branch business and the digital. They don't have that conflict internally. So that gives them a competitive advantage where acquisition of customers and acquisition of assets is shifting to the digital. And we hear the argument all the time in Australia and New Zealand and the UK about the social implications of this. What about these communities who rely on branches, like the post office? What's the responsibility of commercial organisations? Well, the reality is you can't expect a commercial organisation to provide social infrastructure. That's not our job. That's not the market's job, right? That's the government's job. So ultimately, the best we've come up with right now is sort of this banking hub concept where we integrate some basic branch services into this. But we don't have this conflict in India or China, really, when we're talking about where this is going. We certainly don't have this conflict in Africa, talking about branch social infrastructure. A study was done, it's a little bit old now, but 2018, Standard Bank and Accenture did this piece of research where they discovered that it was going to cost 80% of sub-Saharan Africa an entire month's salary to just physically get to one of the bank branches that was available in Africa. So financial inclusion was never going to happen through bank branches in Africa. And we realise today we've brought 2 billion people into the financial services system through mobile phones in just the last 13 years. So we know when it comes to financial inclusion and the best type of financial services moving forward, they're going to be digital. So we require some education and we require digital infrastructure to be able to bring these people in these communities along. But that's a policy problem, right? It shouldn't be a bank problem to deal with this. So the end result of this is if we look at the top 20 fintechs versus the top 20 banks in the world today, it's not even close. The top 20 fintechs have almost 4 billion customers. The top 20 banks have 2.7 billion customers. Over the last 5 years, in terms of customer growth, we've seen 200% growth with the top 20 fintechs. We've seen 45% compound annual revenue growth. And we've seen just 3% for the biggest banks in the world and 15% revenue growth. So I ask you again, in 10 years or 20 years' time, who are going to be the biggest banks in the world? They're going to be technology companies. They're not going to be traditional players unless those traditional players have also become technology players. And so ultimately, all of the fastest growing FIs in the world today are digital first organizations. Not in the top 50 fastest growing institutions in the world, there's not a single incumbent in that list. And that includes MasterCard and Visa, by the way. But that's only half of the story. Because the biggest shift is actually in the modality of what we call a bank account. And wallets are completely changing the game in respect to that. So we can see from Juniper research, 60% of consumers globally will use a wallet as their primary payment vehicle in 2026. We see the fastest growing payments network in the world in Brazil today, 75% adoption rate for the population. Not to be outdone, India with the UPI rails, 80% of retail payments are going to be paid by bank by 2027. 62% of digital payments, already 300 million active users last year. And in China, 92% of all retail commerce goes through mobile wallets. So when we look at the biggest economies in the world in terms of how they're adapting, it's already gone to wallet, right? And paid by bank. And this is tough if you're still issuing plastic cards, right? And you're still dependent on interchange. Those businesses are going to be compromised. And we can see the trend is obviously going towards cashless. You know, it's happening here in Australia. These are the top 10 cashless economies in the world. And yes, there's some pushback and so forth. But I love this quote from William Gibson in his book, Count Zero. He said, "It's not that money was illegal," because he's talking about this protagonist in the future and this future system of payments. He said, "It's not that money was illegal, it's just you couldn't do anything useful with it." And I think that's a good way to sort of think about how our cash will be in the economy in the future. So Juniper has one projection, but WorldPay had this projection that 55% of all retail transactions at the point of sale next year will be done with value store-based mobile wallets. 30% by cards and tokenized cards, and 10% cash. That's a pretty... the shift has already happened. The majority of the world is no longer using cards. They've shifted to pay by bank embedded in a mobile wallet scheme. So here's where I normally ask the question. How many of you have a plan to sunset plastic cards out of the bank? Because plastic cards are 1970s technology in a 21st century world, and they are losing dramatically to wallets. Right? I don't care if your cards are contactless, right? Because once you start getting AI in the mix, it's that smart wallet that's really going to change your payments behavior. Gen Zs get it. 80% of Gen Zs use wallets today. EU, Brazil, Russia, Australia's right up there, of course, in terms of that. So what we're really talking about is the emergence of a smart bank account, an AI-based bank account that, shepherds you as a money coach and helps you manage your financial health over time, and also your physical health. Your longevity is going to be managed in a wallet, right? Because your wallet will be where your healthcare data and your health biometrics and so forth are in that. So that's going to be part of an operating system based on AI in the Amazon stack, in the Google stack, in the Apple stack, and so forth for that core technology. And you will talk to your AI. You will increasingly, as your AI gets more powerful and you give it agency, you'll say, can you send Adam that $150 I borrowed off him the other day? And you just don't remind me later, right? Your AI will do that for you. Your AI, you'll trust your AI enough to do that. And this is where it gets really interesting, because once we have that sort of relationship with our personal AI, think about how we differentiate humans today in the branch ecosystem and the argument we've had for why humans still have value. We've always said humans will give you better advice. But that's not going to be the case once you've got a personal AI integrated into your own wallet that knows your behavior better than your spouse. Right? At least financially speaking, right? Anyway, so we can see the early stages of this sort of smart wallet or smart bank account emerging. This is Apple's ecosystem, obviously. You can see instant categorization, a geotag there. Imagine now AI in that mix. What could you do with AI in a smart wallet that you can't do with a bank today, even in a branch? Well, you could ask your smart wallet, hey, Alexa, can I afford to go out for dinner tonight? It'll know the answer to this. If you go into a teller at CBA on Collins Street and you ask the teller, can I afford to go out for dinner tonight? You'll get a rather strange look, right? But your AI is going to be quite comfortable with that type of integration into your life. And that's why the element of control or management of your finances shifts to AI so quickly in this, because we'll be so comfortable with that personalized element. Now, this is a data problem, right? This is a data solution to try and get this. And we can see this already emerging in solutions. So Alipay 310, 3 minutes to apply, 1 second approval, 0 humans involved. In 2022, they serviced 53 million SMEs in China with small business loans. Their NPL ratio was basically half the best banks in China. Now, this is interesting, because 10 years ago, when all these fintechs and wallets were coming out, one of the arguments that the industry made was these fintechs and wallets, they'll never be as good at credit risk as at us. We now know that's demonstrably false, right? Why? Because credit risk is a data model problem, and it's a tech stack problem. And these guys have better tech stacks and better data. Why can Alipay reduce their NPL ratio on SME lending? Because they have cash flow. All the merchants are sitting on the Alibaba system. They know how their businesses run. They know exactly based on cash flow. Alipay never has to ask for 3 years of financial statements to assess a loan. So they've already got that advantage. So where are you getting that data? You have some cash flow data, but do you have all of the business's cash flow data? Can you provide a platform for operation of a business based on AI? With smart contracts you can, potentially, in the future. So Of course, at this stage, we normally get the argument of cybersecurity. What about cybersecurity? So let's look at fraud, because these numbers are telling as well. Alipay has the lowest fraud rates globally in terms of payments in the industry, just 0.0006 basis points of fraud at 500,000 transactions per second. This is during Singles Day, November 11th in 2022. I don't have the 2023 numbers as yet. But here's what's really interesting. Visa's theoretical maximum is about 50,000 transactions per second. So Alipay is already operating at 10 times that rate. And when you look at the United States, card not present fraud, 11.2 basis points of fraud. That means if you use a credit card online in the United States, it's 10,000 times riskier than using a mobile wallet in China. And in Australia, it's not that much better, right? It's about 5,000 times more fraud, okay? For every $10 million worth of transactions. Why? Because we have better data, we have better identity infrastructure. This is 21st century banking and payments infrastructure we're seeing developed here. So as I say, Australia's CMP fraud is about 5.75 basis points. But as we start getting artificial intelligence and we get the next level of technologies, not the metaverse, but augmented reality. And I know if you look at Vision Pro, you might say, oh, it really hasn't taken off. But this is what Apple and players like this are investing in as the next big consumer level technology. And if you think about it in this way, the way computers evolve is computers get more and more powerful over time and much easier to operate over time. In the 1960s and 1970s, you needed a computing degree just to operate a computer. Now, an 18-month-old child can pick up an iPad and be competent within minutes. But the next level is to remove the computer as an interface. Your screen will be projected on your field of view with smart glasses, and voice and behavior will be the way your AI-based computing stack gets your instructions from you. At times, you may need a screen to come up or a virtual keyboard and so forth, but computers are going to live with us based in AI and respond to our needs in real time based on context. And one of the ways we'll do that is through head-mounted displays or computers in our field of view. So this is a clip from a few years ago, but sort of Project Aria from Facebook. And they've now produced their smart glasses with Ray-Ban, of course, and they're investing billions in this technology. So imagine walking around the world with these smart glasses. What are they doing? Well, one of the things is they're using AI and image recognition to map the world around you. So recognize objects like people's faces, desks, lamps, computers, and so forth. What this means is you could ask your AI, personal AI, hey, do you know where I left my car keys? And it'll tell you, yeah, you left them on the coffee table, and give you GPS directions in your house to go find them, right? Or when you're out on the road and you say, oh, I'm going to order my coffee, you could tell your AI to order in advance. You walk into your coffee place and that's it. Your coffee is ready for you. What you don't do is you don't take your smart glasses off and tap them on the point of sale to do a transaction. The AI takes care of that payment invisibly. There is no form factor for payments in this AI-based world. It just happens contextually. So what might those interactions look like? Imagine walking into a grocery store and being told on your smart glasses, it looks like you don't have enough money to buy your groceries today. Why do we know this? Well, we know you've got $400 in your wallet. We know you spend $600 when you walk into Woolies or Coles. And so I can offer you credit to meet your objectives of your family grocery shopping in real time. Instead of waiting till you get to the checkout, swiping your debit card, having it declined, and then what do? Oh, can you run it again? Like magically more money will come into my bank account, hopefully this time. And a traditional banker will say, you need a credit card. But a technologist will say, no, you don't. We have all the data we need. We know how much you spend grocery shopping. We know you just walked into a grocery store. We know what your wallet balance is today. We're going to circumvent the whole choice of a credit card and give you credit offering in real time. That's embedded credit, contextual credit. Or you walk into a Tesla dealership and your smart glasses tell you this is what a Model X is going to offer you, right? Or cost you. And based on your current salary, doesn't look like you're going to be able to afford that. Here's the Toyota dealership around the corner, right? Anyone in the mortgage business here? Right? So how do you know your customers are looking for a mortgage? How do you know your customers intend to buy a home today? They're going to come and use a mortgage calculator or fill out a mortgage application, right? But Apple knows they're looking for a home because they downloaded a real estate on their app. Google knows because you've been doing real estate searches, for a couple of months now, looking at what you can afford. Facebook knows because you joined a property investment group. So when you walk into a listed real estate property and get an offer in real time for home financing, your bank is still waiting for someone to come and ask for a mortgage, and Apple is now already becoming a gatekeeper, funneling a mortgage offer, a home financing offer with one of their technology partners, because they know the customer's intent to buy. You don't have that data yet, right? So let me give you one final illustration before we wrap up for Q&A. This is a clip from to illustrate the smart bank account operation. This is a clip from a sci-fi movie called Ready Player One by Steven Spielberg. You might remember watching this. The protagonist, Percival, he walks into this store, virtual store, and he's buying stuff. He buys his Zemeckis cube. And watch the transaction here. The X1 boot suit, how much is that? 33K, fantastic, that's the transaction. That was it. And then real world pickup, the drone delivers this package to him in his van later. There's no scenario where in this virtual or augmented payment smart banking world where in the metaverse you're going to have a virtual point of sale with a virtual credit card. That's just not going to happen. And that is going to teach us that the best form of payments, the best form of a bank account is something that lives with you and adapts to your needs in real time, including giving you the optimal payment vehicle for this specific transaction. So if you have a merchant that you have a specific relationship with and you have reward points, your AI is going to work out that it can get the best discount using those reward points, and then it's going to pay out of your crypto or whatever for the remaining funds. And the AI is just going to do that without you having any choice. You won't choose which card to use in this world. Your AI will choose. So you better have a good relationship with the payments AIs. That's all I can tell you. But the good news is there's lots of opportunities for alternative styles of bank accounts. Everything's going to bank. All these drones delivering packages, these autonomous vehicles and so forth, they're all going to be in this smart contract autonomous banking system, and they're going to need to have value stores of their own, wallets of their own. Yes, they may be attached to a autonomous corporation or a DAO, and so forth, but, there's a lot more opportunities to create bank accounts for this autonomous world beyond just humans. That's a really exciting opportunity. So I want you to think about this. Wallets are just next generation bank accounts in the cloud. But I will, and I'm going to talk about this in a minute, but I will tell you, if you're not in the cloud by the mid-2030s, you're probably not in the banking business anymore, because you won't be able to do this stuff unless you're fully integrated into that. So I want you to think about this. In terms of your agility, the advantages these players like Nubank and Alipay and so forth have is they don't think about their core system at all. You didn't hear Ann Bowden when she was CEO of Starling ever talk about her core until after, they built their own core essentially to sell, because it's all tech stack. David Valles from Nubank, Henry Ma, the CIO at WeBank, they all talk about their tech stack, because their tech stack is what gives them their agility for that. And they're much more agile when it comes to stuff like AI. And so what this really means is we can't really have any division of labor in the bank anymore where you're arguing over the traditional merits of the traditional system versus digital anymore. You must be digital first if you want to compete with these players who are the fastest growing FIs in the world. So 2050, what does a bank look like in 2050? Well, think about what the economy is going to look like. The economy is highly autonomous, smart contracts, autonomous exchanges, digital money, robots and AI running all of this function of the economy. The building blocks of smart economies is smart banks, smart payments infrastructure, autonomous banking, autonomous infrastructure. So a bank in 2050 is a set of algorithms, right? JP Morgan Chase today, 160,000 employees. In 2050, if JP Morgan still exists, they might have a few thousand employees, and the rest is algorithmic based. And that's the trajectory we're on. And if you want to compete in this world of the future, that's the trajectory your business must be on. Technology and digital first. Yeah, you can have a human factor and so forth in that, but the fastest growing FIs in the world are all digital first. So thank you for your time today, and we'll cater for some of the questions you guys might have. But thank you. Where do you want me to sit? Okay.
Yes.
All right, here we go.
Okay, thank you. But on behalf of everybody, Brett, I think you've kept us spellbound for, I think, a good 40 minutes or so, and I have no doubt that there are many questions in the audience. I'm going to throw you a couple,
Please.
And then I'm going to throw to the audience. So I want to start by saying thank you. Very thought-provoking, very challenging, a little bit scary. Only in a good way.
I think if I didn't scare you, then you weren't listening, I guess, right?
So you alluded to it a bit, but you and I talked very briefly at the table. I'm going to start by asking you about something you didn't talk about, and that is, how do you see quantum fitting into the picture that you've just painted?
Have you guys heard of, oh, you folks, sorry, gender neutral. Have you folks heard of Q Day, Quantum Day? It's a concept that's talked about in quantum circles, which is, according to the CEO of IBM, when we get a 100,000 qubit quantum computer that's error correcting, we will have a quantum computer that can break all existing RSA encryption, right? So that means all of the internet, all of the banking systems we have today, all of the payment systems would be laid open to someone with access to that quantum stack. Now, if this sounds like science fiction or a apocalypse dystopian movie to you, let me give you one piece of evidence that's at least states are taking this very seriously. Do you remember in 2022 when the US sent an F-22 fighter to shoot down a Chinese weather balloon? Do you remember that? So that Chinese weather balloon was sitting over the United States capturing signals intelligence, capturing encrypted military and government communications for the day that China will have a quantum computer that can unlock or decrypt those communications. And the US military is spending $1 trillion on post-quantum encryption right now. Apple is spending about $30 billion on the same. So Apple and the US military knows where this is going. And China spent $18 billion on quantum last year alone in terms of investing in quantum, because they think they're going to be able to use quantum to break US military encryption. So if they can use quantum for that, hacking a banking system is not going to be all that hard. So if you're not on the cloud in the early 2030s using quantum encryption as part of your cloud stack, your on-premise solutions will no longer be safe. That's the end result of it. Because not every bank in Australia can afford their own quantum computer.
Yeah, something else to think about. Great, thanks.
Sorry.
Let me take you back to some of the statistics and the data that you presented around the sort of growing supremacy, if you like, of Alipay particularly. To what extent do you think that their rapid success is connected to pretty active, I think, state support in a centralised economy that's vastly different to most of the Western economies that you're comparing it to? To what extent do you think that accelerated? For those of us who've visited China many times and gone to markets where there was no way in the world that you were going to buy a fake T-shirt for anything other than cash, and now you can't find a market where you can use cash, and that happened in a very small, a pretty small time frame. But to what extent, like when you compare Alipay to other payment systems around the world and its acceleration of success, to what extent really is it partly reliant on state support and state control?
I wouldn't say, I would say that's a factor, but I would say actually if you see the People's Bank, central bank's response to the dominance of Alipay and WeChat Pay, back in 2018, and the pressure that was put on Jack Ma for his comments, clearly they were actually disturbed by the rapid success of Alipay, to the point where UnionPay 2.0, which is a large part of the open banking strategy in China, forced the fintechs to open up their data to banks, right? Which is the opposite of what we normally think about with open banking. But I would say that it's less to do with state support and more to do with two elements. They're very, very good at digital identity infrastructure, which made it very secure and produced an element of trust in the ecosystem. And I think the other element was network effect. So if you look at why Alipay and WeChat Pay was so successful, it goes back to 2014. And if you've ever been in China or Hong Kong around Chinese New Year, they have the red packets, the Lai-C packets they give. And these guys, it was actually Pony Ma from Tencent who had the original idea. Jack Ma followed up, which was, well, we could do electronic red packets. And so that was a piece of brilliance, because when now you're sending gifts at Chinese New Year to your families and friends and relatives and so forth with money in a wallet, what do you do with it? Well, you go and spend it. And suddenly now you had this flood of people with money in a mobile wallet, and they're asking merchants, do you accept Alipay? Do you accept WeChat Pay? And the merchants were like, oh, I don't really know what that is. And they'd go on, they'd download the app, and they'd be able to accept a payment within minutes, right? So there was no point of sale infrastructure required. There was no merchant contracting required. That network effect really created that element. But it was also that they did have in parallel to that the digital identity infrastructure. So when we look at what's happened in India, their success with the UPI has also been reliant on the Aadhaar card as an identity infrastructure that's created. But remember that, while China has been very successful, both India and Brazil have much faster growing payments networks today than China does.
Interesting, the connection with the digital ID, because you may or may not be aware that Australia hasn't been the first, we haven't been on the cutting edge of this, and our Parliament, I think maybe about 8 weeks ago, passed
I saw that.
the digital
we now have a
ID
head
bill.
of digital identity, right? Yeah.
Well, there are probably most people in the room may not have had an opportunity to check the parliamentary notice paper from today, but a group of parliamentarians today moved a private members bill to repeal the Digital ID Act. That's not even 6 weeks old, so it's still an idea in Australia that doesn't enjoy unanimous support.
If you don't mind not competing with 21st century economies, then appeal it.
I'll introduce you to some of these guys sometime.
No, I think I think COVID gave us a bit of a glimpse, right, of what the 21st century economy was like. We're in lockdown and so forth, and if you wanted a restaurant, delivered meals, you had to do it digitally. Your kids were attending schooling digitally. That's just a small glimpse of how, in the 21st century digital services layer, the best digital services, the best services for citizens will be digital. And it makes sense that you're going to need robust digital identity infrastructure. I mean, when you come into Sydney or Melbourne today and you come through passport control, it's very rare that you're having a human look at your passport and compare your face, because we know that the cameras are just 90% more accurate than a human at, assessing your identity coming through that. So if it's good enough for passport control, then I think it should be good enough for other elements of society as well.
My last question, and then I'm going to throw to the audience. You finished with, or you came close to finishing with, expressing the view that, like all culture, digital culture starts at the top. when I think about the people who are not just CEOs, but the senior executive teams, the people who are deciding strategy, the people who are making investment decisions in Australia's banks, large and small. They're not always the oldest people in the bank, but they're very rarely the youngest people in the bank. And they're in these positions because they've actually had a lot of experience and spent a lot of time developing skills and capability. And that means they've kind of come through, been nurtured by and rewarded by the existing system. So what do you think, how would you talk to people in those circumstances and say, how do you stop thinking like an incumbent?
We have seen examples. Jamie Dimon, Piyush Gupta at DBS, Suvo Sakar, who up until recently was the head of retail for Emirates MBD. I could even, hark back to Michael Hart at the Combank days and so forth. We have seen leadership take on digital as a mantra, and certainly, Chase is spending $1.8 billion a year on technology conversion. But how do you change the culture? Well, this comes back to sort of like, turning the big ship. It's difficult, and these fintechs, they don't have all of that legacy process and policy, and that's one of the reasons they're more agile. So what we have seen, small pockets of really effective, attacks of this. DBS with their launch into India with Digibank, Chase with their launch in the UK market. I think they have like 3.5 million customers with Chase now as their digital entry. Those have worked, but often it's much harder to do that in your home market. So Chase has really failed with creating sort of a neobank analogy in the US. They had an attempt at it with Fin, and it failed, primarily because, and if any of you tried to sign up with Fin during the time, you would have seen this. I was living in New York, and I tried to sign up with Fin because, I'd heard that they'd stolen a lot of tech from Moven at the time. And I signed up, and I got through I put in my social, did all my IDV check and everything. And at the last point where they were going to issue me the card, they said, "Thank you very much for your interest in Fin, but because you live within 50 miles of a Chase Bank branch, you don't qualify for this digital service." And that's why it failed, right? Because there was that tension or competition between the traditional bank and the digital bank. And the first thing I would say is you can't have that anymore. You can't have that argument as a leadership. You just must accept that your future is digital and AI and technology, and you have to figure out the way the rest of the bank plays within that. And if you can't get your head out of that, around that strategy, you won't have to worry about it too much longer.
Okay. On that cheerful note, I think Adam has volunteered to be the roving mic. So can I ask people to put their hands up? When we also have Lauren over on this side of the room. So
I've got the very brave Rachna here, who's volunteered to ask our first audience question.
Excellent.
She's from Southeast Community Links. Over to you, Rachna.
And
Is that
she
a
says
surprise,
anything,
Anna?
Adam, there's another one over at this table next. Rachna.
Okay, so Brett, your presentation or your talk today is such a dystopian world, right? I am a consumer advocate, a financial counselor by profession. And I'm sitting here thinking, in COVID, in 2020, when COVID hit, many of the older Australians were still using passbook.
Yeah.
And that was the first time that the ABA and the banks pivoted towards issuing cards to people so that they could go and get access to cash, right?
Yeah.
I'm also thinking from a perspective when we are currently talking about digital divide, we're talking about people don't have access to technology. In an Australian context, we are very small in population size compared to China and India,
Sure.
right? How do you foresee that when we are just having these conversations and we're very regulated in terms of consumer protections, how is it all going to move ahead in Australian context in 2050 when we still haven't brought people along on the journey on what we are today or where we are today? How are we going to bring them along to 2050?
Well, unless longevity science comes along at the same rate as these changes, we're probably going to have a generational shift by nature of, those older generations moving on, let's say, right? Over 30 years, right? So, but over the next 10 to 15 years, well, we still have a social commitment that's required. There's obviously the banking hub, and there's also shared branching strategy and shared ATM strategies that can work, which requires a cooperative approach that we don't generally see amongst the big four in Australia or the biggest banks in other parts of the world. But that's one way to solve that problem is, we get together and we provide shared infrastructure that caters for those community needs. What we've seen in places like India and China is, yes, there has been an effort to modernize those systems and bring those people along, but things like family interactions where families are using those mobile, it's the kids who are teaching the grandparents how to use that tech and making them comfortable with it. That's sort of they're empowering the generational shift. So I get the community advocacy stuff, and I get that there's social conditions that might cater for that. Ultimately, this is a government policy issue. The technology is not going to wait, for communities to adapt to that, and that's why you get that displacement. So you have to have policymakers who are very aware of what the future is going to become and start to work on proactive solutions to bridge that gap. And that's where the problem is, because what we spend far too much time arguing is whether it should happen or shouldn't happen, instead of realizing that it's going to happen and we need to manage that transition as orderly as possible. So, for example, there's a lot of debate around artificial general intelligence right now. And a lot of people are saying, I don't believe we're ever going to get AGI or whatever. And that's the wrong argument to be having right now, because AI, the capitalist system and the free market is doing every single thing in its power to produce that AI revolution. So the only way, ultimately, you could stop this is by eliminating capitalism from the system. Right? Because capitalism is going to drive these changes. Now, ultimately, in the 2040s and 2050s, we need a better solution than capitalism, because capitalism also is producing the highest levels of inequality we've seen in the last 300 or 400 years, and that's unsustainable in an environment with high AI and climate change risk and so forth. So this comes down to us managing the transition for these affected groups better than just sort of saying, we shouldn't be having the conversation of whether it's the right thing or not. We should be working out how we manage the transition for these affected groups better. I hope that answers your question.
I think there's a whole other series of questions about whether the regulatory framework, whether regulators are ready for this and how they're thinking about it. Because regardless of how services are delivered, at some point, consumers will want protections. And how do you give them those protections in this kind of environment? I thought about that as you were talking about that moment in COVID where we sent out, I think we sent about 500,000 cards to passbook account holders. Now, that was about a 25% take-up, which is actually huge, really,
it's great.
in that environment. But we needed regulated dispensation to do it, because it otherwise would have been against the law, which prohibits the unsolicited provision of products. So, just a good example of when there's an emergency, it exposes how sometimes the rigidities in the regulatory system are not keeping pace with how things are changing.
I'll give you one example. We often, you hear merchants in the US argue all the time, that it's too expensive for them to run card schemes and cash is better for them. Well, we actually have data now that cash handling for US merchants costs about 15%, so $15 for every $100 transaction. So even compared to card schemes, and certainly paid by bank, low interchange rails, there's no comparison. And so merchants are going to obviously move away from cash handling because of the costs and risk associated with that. So if you've got people who are, in the cash economy and reliant on cash, you need to be very proactive about coming up with solutions for them. Keeping cash available is not necessarily going to be viable when merchants say it's just too expensive, too risky, for me to manage.
Yeah, we're not talking about cash. Don't mention the war.
Right,
you don't know about the war. Lauren, over here.
Thank you. With so much automation and AI, What type of jobs do you think the average person are likely to have in the future?
Wow. Well, there's a great, if you want to look at a great example of this, there's a guy out of the UK called Dave Shapiro, and he talks about the meaning economy. And he basically identifies 4 types of jobs. There's going to be statutory and regulatory jobs. So this is attached to managing, AI integration into society. There's going to be human experience-based jobs, so education, digital nomads, travel, lifestyle experiences and so forth. There's going to be human care and human adaptation. Right? There's sort of the 4 types of jobs. But here's the key thing is, and we're going to go through a transition, as we start to see all this technology unemployment surfacing because of AI, we will probably come up with things like universal basic income structures or something like that to smooth that curve, the same as we saw with stimulus payments during COVID, but something more permanent. And that's an effort to sort of keep consumption going and keep the economic system. But in the 2040s, when I ask you what you do, it's not going to be a job that puts food on the table, because the economy will be wealthy enough because of the wealth that AI has created to look after basic needs of most citizens. It's going to be what you're passionate about. And the biggest growth industry in the 2040s will be climate resilience and climate mitigation. So that's probably where a huge amount of effort will be. And for economies like Australia and other economies, we may require citizens to do a couple of years of climate mitigation work, national service, before they qualify for something like universal basic income as an idea. But keep in mind also that the US really will start to run out of options in the 2030s in terms of their approach to their national debt. So there may be a movement in the mid-2030s to wipe out all national debt globally in response to the climate pressure that's being put on, and also mass immigration. By 2050, the upper estimates are about 2 billion eco-refugees on the planet. So we won't be able to stop people movement. We'll have to come up with a much broader plan for how we deal with those large-scale eco-refugees. And the question of who's going to pay for it will become, at some point, morally untenable, right? Because the volume of people movement produced by sea level rise and farmland failure and so forth because of perennial flooding will be consistent enough that question will be no longer morally appropriate. So what it basically means is that by the 2040s, the meaning economy means that when I ask you what you do for work, it's what you're passionate about. It's not what you need to do to put food on the table.
We have one here, Adam.
Okay, yes. I'm mindful of time. We'll take one more question here and one more in the middle of the room.
Darren from Suncorp Bank. Brett, thanks very much for the delivery. Fantastic, thought-provoking dystopian maybe. I was fortunate enough to attend last year's conference, and Jackie Curnow from Accenture gave us a little bit of background into quantum computing. But before that, and your sort of pet project, the powers of prime numbers, really large prime numbers that are used for the public-private partnership for RFIDs that back all of our securities, and the whole thing about having quantum computing with all of the stuff that's being generated through the dark web and those sort of algorithms, and finding a way to break that kind of intrinsic link that all of our banking systems are based on. I'm just wondering if you had any comments for the record.
Well, I mean, ultimately, polymorphic quantum encryption, is sort of the name of the game that we see in terms of securing these future systems, which is why I talk about the quantum stack in the cloud, is that most of these players, Amazon, AWS, Google Cloud, and so forth, will have quantum integrated into the stack. Apple will have it integrated into their ecosystem. And so, it'll be quite easy to add, adaptive quantum encryption if you're in the cloud. It'll be much more difficult in sort of hybrid and on-prem solutions, because you'll have to sort of have a pipeline for that. But this is a problem that we're going to have to deal with on large scale systems, governments, military, and so forth. The only saving grace is, while criminal organizations may get access to the quantum stack, we may be able to, using AI, filter their ability to use this for attacks on existing encryption algorithms. But only for so long, because how long is it going to take for someone to be able to replicate that type of capability with AI, for example, versus quantum? And there may be ways around that with AI married with quantum, where they can do those attack vectors. And what we're seeing today, if you look at cybersecurity, generally speaking, the criminals are much more advanced at using artificial intelligence for brute force attacks on the banking system. And that tends to be why the cloud ecosystems are more secure than on-prem these days, because they're getting attacked so frequently that it's like an immune system. It gets strengthened over time. So I think the same is probably going to be true for that. Where the most attack vectors are happening on those cloud-based systems, you're going to get the strongest ecosystems emerge. But what we don't see yet really is a way to sort of get classical computing architecture with AI on the top of it married with quantum. We don't have a clear line in terms of how that's going to happen. So that's the sort of unknown factor in this. But that could go either way. It could make classical computing more robust and give us a way to come up with AI-based encryption that is quite good. But it could also go the other way, which enhances the ability of quantum to break existing algorithms. So.
I think that was a kind of nerd on nerd bro talk.
Sorry.
But thank you. Last question, and then we'll let you get back to some networking.
Thank you, Brad. It was an interesting presentation. A lot to unpack there. I think there's many in the audience yearning for the good old days of passbooks and plastic cards. Just wanted to unpack you've talked a lot about AI in the context of sort of application in the corporate sense. There's obviously a very large nation-state focus. How do you see the geopolitical elements around this playing out as well?
Well, I think part of what we're seeing with the BRICS stuff at the moment is sort of geopolitical negotiation around these types of systems. We're going to see a lot more regional-based regulation and systems. Governance, just with AI and climate change alone, we're going to need to see governance cross-border much more aligned. You could already see this happening with things like GDPR, where GDPR became a template for a lot of other data privacy regulation. The regs that we've seen in the EU with AI, the regs in China we've seen AI are now becoming adapted, because regulators have to move a lot quicker than they used to. And so rather than come up with new regulation from scratch, we're seeing regulators talk a lot more to each other. That's likely to mean that from a regulatory perspective, when it comes to AI-based regulation, when it comes to banking regulation and so forth, we're going to see a lot more cross-border systems emerge with sort of regionally based regulation. And BRICS and the EU would be the two starting points for that in that respect. But I think you have to look at it a bit further as well, is at the same time that that's sort of happening and we're looking at more autonomous systems working together cross-border, at the same time we're trying to automate a lot of the systems that we have in Australia and New Zealand and so forth, and we're injecting AI into the system. We're taking existing laws and implementing that in code, so that a lot of the legal and justice environment and so forth increasingly will be done automated as well. So for example, in Shenzhen today, if you're driving in Shenzhen, there are no police on the road stopping you with radar guns, right? They can use cameras on the road to detect your speed, and they just text you a fine. Right? If you're not wearing a seatbelt, they just text you a fine for that. The first time you get a warning, the second time you get an SMS fine. And that's reduced the cost of policing. It's reduced accidents on the road, because as we all know, if there's an accident on the Mulgrave Freeway or something, and a car's pulled over the side, what does everyone do? Everyone's having a look at the accident. And so AI elements of sort of controlling those instances. So for example, what emergency vehicles you send to an accident will be dispatched by AI and so forth. That's just one small example. Power management is going to be a massive problem, with AI. The power demands of AI require us rebuilding our grids, and it has to be based on renewable energy, maybe fusion in the 2040s and so forth, a lot more battery storage systems and so forth. We can see China has deployed more solar in the last 12 months than the US has has historically throughout their entire history. So China gets that the demands for energy require rethinking the energy grid to support these sort of autonomous systems. Sanitation management, water management, food security, all of this we're going to be using artificial intelligence to try and create more robust systems, because the changes are going to be happening quickly, and climate in particular is going to produce a lot of problems. Look at, I don't know if you saw the news coming out of Jeddah, out of Mecca recently. We had 100 pilgrims die because of heat exhaustion, exposed to that. In parts of Dubai, in the Middle East, it's going to become almost unlivable, same as certain parts of Australia, unless we engineer our environment to cope with these extreme temperatures. Bangladesh, Maldives, Tuvalu, Tonga, these are all nations going to be radically affected by sea level rise in the 2050s and beyond. So we need a large-scale rethink of how human infrastructure will work in this environment. It's not only AI, but it's also climate resilience and climate mitigation, which will require us to sort of re-engineer our societies along that state. And at the same time, what we're also doing is making these systems massively more efficient and much more cost effective. So the cost of government as a whole and bureaucracy is reduced by this level of automation. But we're going to have to hand off a lot of that to AI. And who manages the AI, particularly as AI gets smarter? And that question of super intelligent AI and the fact that humans will have to negotiate with AI in the future as an alternative intelligence is one that we've only ever sort of really thought about with aliens coming or something in the future. We see these movies like Independence Day and stuff like that, where the aliens who are much smarter and more advanced than us come along, and we've got this negotiation that occurs, normally through some sort of military action. But with super intelligent AI, they're going to be asking us questions and proposing solutions to human systems that fly in the face of conventional wisdom and sort of traditional approaches, particularly on things like fossil fuel, right? And, the way we think about food production and things like that. And, that's a negotiation process that we really don't know how that's quite going to go, because we've really not had to negotiate with superintelligence before. So it's, but ultimately, I'm not a dystopian futurist in respect to this. I think the technology will free us up from so many of the negative elements of human society. We'll be living longer, we'll have a much more leisure time, we'll be healthier, much longer, we'll live longer lives and so forth, and we'll be able to tackle things like homelessness and poverty. We'll, we have the technology to solve those problems today. We just don't have the policy. And automation of these large-scale systems will force us to rethink about policy in that environment. So when we start thinking about like cash and payments and all of those things and the community elements of that, ultimately, I think the technological solutions to those problems will be patently obvious and will produce a far better quality of life for most people. And that's the trend. If you look at life today compared with, before the Industrial Revolution, life for humans today is obviously far better than it was back in the 1800s, and that trend is going to continue. But, some sacred cows are going to be put aside. Yeah, exactly.
Ladies and gentlemen, thank you. Can I ask you to join me? Brett, it was terrific. Really terrific. Thank you.